Today is the big day, the first MPC meeting for the year 2022, and it's the day 2 of that meeting, and the CBN governor is seated as we speak. In a few minutes we'll start to reel out the resolutions from that meeting. Okay, I hear that already the central bank governor has started speaking, so we'll cross live to our Abuja studios, to headquarters of the central bank, I beg your pardon, in Abuja, where the CBN governor would start to reel out the resolutions after this 2-day meeting. A lot of discussions around the MPC meeting and expectations, considering all of the headwinds that we go through as a country. Many are worried that inflation rate, which is also on the high side at the moment with what we saw in the month of December, might affect the decision of this meeting. Some also look at the macroeconomic fundamentals. A lot of issues to look at, global issues, COVID-19 remains, the stock market. A lot of considerations today, but let's see what these men and women that have been in for 2 days, let's see what their resolutions will be, and let's see what they will come up with today. We'll go to Abuja now, CBN headquarters.
2022, on the 24th and 25th of January 2022, in the light of waning optimism for a robust rebound in global recovery in 2021. This resulted from the persistence of the COVID-19 pandemic and emergence of new variants of the virus, persistent supply bottlenecks, unabating global inflationary pressures, and the imminent commencement of monetary policy normalization by some major central banks. In the domestic economy, output growth recovery was relatively strong in 2021. It is, however, expected to progress reasonably in 2022, following considerable improvement during the third quarter of 2021 and a positive outlook for the fourth quarter of 2021. This is hinged on the continued support of both the monetary and fiscal authorities to sustain the current momentum. Committee reviewed the developments in the global and domestic economic and financial environments in 2021, as well as the outlook and risks for 2022. 10 members of the committee attended this meeting. Global developments. The committee noted that while the recovery of the global economy in 2021 fell below the initial forecast, final estimates showed considerable improvement over the 2020 outcome, and evidence that the global economy was pulling out of the doldrum associated with the pandemic. Consequently, the recovery is gaining momentum with increasing consumer spending, upswing in investments, and soaring world merchandise trade above pre-pandemic levels. These reflect the resilience of economic agents in the face of new strains of the virus and rising infection rates. Committee, however, took cognizance of significant headwinds confronting the global economy in 2022, largely associated with persistent threats of new variants of the coronavirus. The advanced economies are, however, in a stronger position to offset the impact of these headwinds with stronger policy support and better access to COVID-19 vaccines. Consequently, this group of economies have shown better resilience towards the disruptions to recovery. In the second term, however, the rising inflationary pressures and the gradual withdrawal of both monetary and fiscal stimulus may dampen the recovery expected in 2022. As for the emerging markets and developing economies, poor access to vaccines and limited policy support meant that this group of economies have been harder hit by the COVID-19 and its associated macroeconomic downturn. In China, for instance, one of the few countries that stayed out of recession in 2020, output weakened during the third quarter of 2021 and has continued to weaken as the COVID infection continues to rage amid power supply problems and turbulent property market in that economy. Following the containment of the infections in India, the economy has commenced a sharp recovery and is set to continue on an upward trajectory. Overall, growth in the emerging markets and developing economies is expected to slow in 2022 due to the low level of vaccination and limited policy support in several economies in this group. On price developments, MPC observed that inflation in most advanced economies remained high and unlikely to abate in the short to medium term. This is driven by the persistence of supply-side disruptions and pent-up demand associated with recovery from the virus. In the emerging markets and developing economies, inflation has also remained high due to a combination of persisting exchange rate pressures and supply bottlenecks associated with lockdown restrictions. With the US Fed and other advanced economy central banks now moving towards monetary policy normalization, the eventual lift-off of interest rates may likely trigger a huge capital outflow from the emerging markets and developing economies, which would further aggravate exchange rate pressures with a pass-through to domestic prices. Global financial markets data shows significant sell-off as investors continue to rebalance their portfolios with a shift from assets such as gold and emerging market securities to advanced economy securities, suggesting market response to the impending interest rate lift-off. Global financial conditions are thus expected to tighten as risk-averse portfolio investors reassign their portfolios from perceived riskier emerging market securities to less risky advanced economy securities with the expectation of improved yields. The domestic developments. Staff projections show that the economy is expected to remain on a path of positive growth given the impressive performance during the third quarter of 2021 and continuing rebound in economic activities. Committee noted with satisfaction the significant improvement in the Manufacturing Purchasing Managers Index PMI, which rose to 52.0 index points in December 2021 compared with 50.8 index points in November 2021, reflecting the continuing economic recovery. This expansion was driven largely by increasing business activities in the economy, leading to increase in new orders and uptrend in employment and production levels. The non-manufacturing PMI, however, declined marginally to 48.0 index points in December 2021 from 48.6% points in November, largely reflecting a decline in services. Committee noted with concern the slight increase in headline inflation year-on-year to 15.63% in December 2021 from 15.4% in November, following 7 consecutive months of decline. The unexpected increase was attributed to both the food and core components, which rose to 17.37% and 13.87% in December 2021 from 17.21% and 13.85% in November, respectively. Committee, however, expressed confidence in the bank's sustained intervention programs, noting that inflation will continue to abate as food supply improves. Members also noted that the seasonal drive in price development associated with the December festive period was largely contributory to the marginal increase in price levels, and as such, believes that this episode of increase in December may indeed be temporary. Reviewing the developments in monetary aggregates, committee noted that broad money supply entry rose further to 13.77% in December 2021 compared with 10.10% in November 2021. This upthrust was largely driven by the growth in net domestic assets NDA of 15.58% in December 2021 compared with 9.4% in November 2021. Net foreign assets, however, decreased to 6.06% in December 2021 compared with 14.98% in November 2021. The sharp growth in net domestic assets was largely attributed to an increase in claims on the federal government and other sectors. The slowdown in growth of net foreign assets resulted from a decrease in foreign assets holdings of the banking system in favor of more domestic investments. Committee reviewed the performance of the bank's various interventions aimed at stimulating productivity in the manufacturing and industries, agriculture, energy and infrastructure, healthcare, and micro, small, and medium enterprises between November and December 2021 under the Anchor Borrowers Program. The banks disbursed $75.99 billion to support the cultivation of over 383,000 hectares of maize, rice, and wheat during the 2022 dry season, bringing the cumulative disbursement under the program to $927.94 billion to over 4.5 million smallholder farmers cultivating 21 commodities across the country. All excess outputs aggregated from the financed farmers will be released to the Nigerian Commodity Exchange to help moderate the prices of food in the market. The bank also released $1.76 billion to finance 2 large-scale agricultural projects under the Commercial Agricultural Credit Scheme. In addition, the bank disbursed the sum of $151.23 billion under the Real Sector Facility to 15 additional projects in agriculture, manufacturing, mining, and services. The funds were utilized for both greenfield and brownfield projects under the COVID-19 intervention for the manufacturing sector and Real Sector Support Facility from differentiated cash reserve requirements. Cumulative disbursement under the Real Sector Support Facility currently stood at 1.4 trillion naira, disbursed to 331 projects across the country. As part of its efforts to support the resilience of the healthcare sector, the bank also disbursed 498 million naira to 2 healthcare projects under the Health Care Support Intervention Facility, bringing the cumulative disbursements to 108.85 billion naira to 118 projects comprising 31 pharmaceuticals, 82 hospitals, and 4 other services. To support our households and businesses affected by COVID-19, the bank disbursed 20.29 billion to 40,521,000 beneficiaries, comprising 35,340 households and 5,181 small businesses under the targeted credit facility within the period. The cumulative disbursement under the targeted credit facility TCF stood at 369.78 billion to 777,666 beneficiaries, comprising 648,052 households and 129,614 small businesses. To further promote entrepreneurship development among Nigerian youths, the bank disbursed 293 million naira to 59 beneficiaries under the recently introduced Tertiary Institutions Entrepreneurship Scheme TIES. Under the National Mass Metering Program, the sum of 47.83 billion naira was disbursed for the procurement and installation of 857,026 electricity meters across the country under the scheme's Phase 0. We also note the improved collection by these schools as a result of the increased meter installations. The bank also released 254.33 billion to power sector players as part of its efforts to support the sector under the Nigerian Bulk Electricity Trading Payments Assurance Facility (NBEDPAF). This was in addition to 20.58 billion naira released to distribution companies under the Nigeria Electricity Market Stabilization Facility Phase 2. To further support the development of the enabling infrastructure in the gas industry, the bank released additional 3 billion naira for the augmentation of an existing infrastructure, bringing the cumulative disbursement under the intervention facility for National Gas Expansion Program to 42.2 billion for 6 projects. Furthermore, under the 100 for 100 policy on production and productivity, which was introduced to stimulate the flow of finance and investments to enterprises and projects with potential to kickstart a sustainable economic growth trajectory, accelerate structural transformation, promote diversification, and improve productivity, the bank has received notifications or applications for 224 projects valued at 294.91 billion naira for real sector projects in agriculture, energy, healthcare, manufacturing, and services. The applications are currently being processed, and the first batch of beneficiaries under the intervention will be announced and advertised in the national dailies on 31st of January 2022, with their names published in national dailies. These projects have been carefully selected in line with the approved selection criteria as contained in our guidelines. Money market rates fluctuated within and above the asymmetric corridor, reflecting prevailing liquidity conditions in the banking system. The monthly weighted average open buyback OBB rate increased to 12.75% in December 2021 from 10.61% in November 2021. The increase in the open buyback OBB rate reflected the tight liquidity conditions in the banking system. The MPC noted the continuing positive performance in the equities market in the review period, with the all-share index and market capitalization increasing by 1.61 and 1.63% to 42,716.44 and 22.3 trillion naira on December 31, 2021, from 42,038.60 and 21.94 trillion naira on October 29, 2021, respectively. This positive performance reflects improved corporate earnings as investors increase participation in the market. The MPC also noted the sustained resilience of the banking system following the progressive improvement in the non-performing loans ratio from 5.10% in November 2021 to 4.85% in December 2021, a first in a long time and indeed over many years. The committee also noted that the liquidity ratio remained well above its prudential limit at 41.3%, though capital adequacy ratio declined marginally to 14.53% in December 2021 from 19.90% during the previous month. Committee thus urged the bank to sustain its firm regulatory surveillance. Bank's members noted the continued improvement in the external reserves despite ongoing exchange rate pressures. The reserves stood at $40.2 billion as of December 2022. Our outlook. The broad outlook for the recovery in both the global and domestic economies is clouded with uncertainty as the resurgence of the COVID-19 pandemic, driven by new and mutating strains of the coronavirus, persistent supply bottlenecks, high and rising inflationary pressures, and dwindling monetary and fiscal stimulus. Emerging markets and developing economies are likely to experience a sharp downturn as a result of the identified headwinds confronting the outlook. This is hinged on the back of the ongoing two-speed recovery of the global economy, driven by continued disparities in the administration of vaccines between the advanced economies and the emerging markets and developing economies. Whereas the advanced economies will also experience a downturn in 2022, this group of economies are expected to take a less severe hit as most of them have achieved significantly high levels of vaccination within their communities. Star forecast project output growth at 3.1% in 2021 with an expected better outcome in 2022, consistent with the expected improved macroeconomic performance. This is predicated on expected headwinds which continue to impact global recovery. The economy is, however, expected to progress gradually, with the recovery with ongoing support by the monetary and fiscal authorities, progress with COVID-19 vaccination, and continued high crude oil prices. After a moderate increase in December 2021, headline inflation is expected to trend marginally upwards in the short term before moderating towards the end of the first quarter of 2022. This moderation is expected as food harvests progress towards the end of the first quarter of 2022, thus improving food supply. In general, with the bank sustaining its intervention programs through the year, food inflation is expected to trend downwards in 2022. Available forecasts for key macroeconomic variables for the Nigerian economy indicate expected rebound in output growth for most of 2022, sustained by ongoing broad monetary and fiscal stimulus. Accordingly, the Nigerian economy is forecast to grow in 2022 by 2.86% CBN estimate, 4.2% Federal Government of Nigeria estimate, and 2.7% IMF estimate. Committee's consideration. Committee assessed the balance of risks confronting the domestic economy in the near term as they impact output growth and price stability. Members noted the unrelenting effort by the monetary and fiscal authorities in mitigating the impact of the virus on the economy. It observed the continued moderate recovery of the domestic economy, but requires further concerted policy effort by both the monetary and fiscal authorities to improve the momentum and strengthen their recovery. Members were thus of the view that building on the improved growth in the third quarter and the positive PMIs in the fourth quarter of 2021, output growth is expected to strengthen into 2022. On the pandemic, MPC reviewed its continued impact on the domestic economy as members collectively agreed that the downside risks were still hindering the recovery. In this light, it commended the efforts of the Presidential Task Force on COVID-19 for procuring vaccines and continuing the drive to ensure that most Nigerians are fully vaccinated. On price development, members continue to express concerns about the impact of insecurity in farming communities on food inflation. Whereas headline inflation had been moderating for several months, committee believed that its recent uptick was associated with increased demand during the festive season and was thus of the view that the prices will return to the downward trajectory given the bank's ongoing interventions in the agricultural sector. On this note, members applauded the efforts of the bank with the recent launch of the rice pyramids, noting that these efforts to increase food supply and stem food inflation were in the right direction. Members, however, reiterated the key role of the federal government in providing the necessary security around the country, and particularly in the farming communities, to ensure that farmers and their produce remain safe and food supply is both boosted and uninterrupted. Committee also noted that the ongoing dry season farming will further improve food supply and dampen prices. Members noted the ongoing debate around the removal of fuel subsidy and suggested a robust engagement with the relevant growth in the country, and afterwards follow a stepwise and gradual approach to ensure its moderate impact on cost of transportation and energy for individuals, households, and firms. Committee also noted the need to encourage the takeoff of our private refineries across the country in order to provide alternative competitive local supply source and reduce the need for government intervention to manage fuel prices for domestic consumption. In addition to this, urge the speedy conclusion of the government gas-powered vehicles conversion scheme and other alternative fuel-powered sources. On exchange rate, committee applauded the management's efforts at maintaining stability over the short term with increasing demand as the economy continues to reopen. Members noted the dwindling proceeds from oil sales despite rising crude oil prices. They further noted the need to address the persistent reduction in remittance of oil revenue to the Consolidated Revenue Fund and urged NNPC to urgently address this annually. This improved foreign exchange supply will further support the bank's demand management strategy in the foreign exchange market and consolidate macroeconomic performance, especially those that promote export, reduce dependence on import, and reduce foreign exchange demand pressures. MPC welcomed the improvement in foreign capital inflow through diaspora remittances and urged the bank to further extend the incentive scope to attract more remittances to official channels. The committee noted the rising government debt profile and the concentration of the funding sources and its implication for fiscal sustainability and macroeconomic stability, including its impact on financial system performance and growth. MPC continued to urge the government on the need to harness other sources of revenue to reduce its dependence on oil as a single revenue source. In addition, it reiterated the need for government to seek alternative and more viable and indeed more efficient infrastructure financing sources in order to ease its expenditure burden. To this end, members called on the fiscal authorities to take advantage of the private sector-driven vehicle for the Infrastructure Corporation of Nigeria in order to transfer viable infrastructure projects for consideration by the corporation, as this would ease pressure on government in its drive to raise revenue through taxes from an already burdened private sector and household sector. The improved performance of equities market during the review period signposted continued investor confidence in the Nigerian economy. This, in the view of members, was a positive sign that the economy remained on a path to a more robust medium-term recovery. Banking sector indices. The banking sector indices in the consideration of members showed no less resilience as other macroeconomic indicators reviewed, even as obvious downside risks associated with the pandemic continued to impact the business environment. Members thus applauded the management's efforts in ensuring the continued downward trend of the non-performing loans ratio, signifying improved conditions in the banking system. Nevertheless, members emphasized the need for the bank to closely monitor developments in the sector and swiftly respond to any emerging challenges. The committee's decision. The MPC observed with concern the moderate rise in inflation in December 2021, noting that this was typical of increased aggregate demand associated with the end of the year festive activities. Members, however, expressed their continued commitment to drive down domestic prices by putting in place relevant policy measures to curb the rise in inflationary pressures while also supporting the fragile recovery. In its determination as to whether to hold or loosen or tighten its policy stance, MPC was mindful that whereas the US and some advanced economies have signaled their intention to commence policy normalization, which may result in capital flow reversals for the emerging market and developing economies, the major focus of these climbs were targeted mainly at reining in the high level of inflation, which had been unprecedented in the last 4 decades in those climbs. For Nigeria, members were of the view that Nigeria is confronted by not only inflation, but also fragile output. As a result, MPC believes that its current stance of price and monetary stability, conducive for growth, remain desirable. The MPC is convinced that various measures being implemented were helping not in boosting output growth, but also in moderating inflation. MPC therefore enjoined management to continue to use its development finance tools to accelerate output growth, which would also help in boosting manufacturing output that would ultimately help in moderating prices. It also requested management to continue its use of administrative measures, including discretionary tools at its disposal through the CRR to control money supply in the economy. In its final consideration, the committee was clear that a loosening option was not desirable because it will trigger further liquidity surfeit and fuel inflationary pressure, as available funds may outstrip the economy's absorptive capacity or domestic capacity utilization. It also feels loosening could trigger foreign exchange demand pressure, as the excess liquidity will be channeled to either frivolous importations or speculative holding of foreign exchange as alternative investment channels narrow, leading to foreign exchange depreciation and or inflation. MPC also dropped a tightening option at this meeting in view of the fragile state of the current gross domestic product growth rate and potential external and domestic headwinds confronting the economy. MPC also feels that tightening could truncate the steady improvement in credit performance, including other financial soundness indicators, and reverse the declining trend in NPLs. Moreover, MPC feels tightening could counteract the CBN's credit expansion motive as a necessary condition for improved economic growth and employment generation. The MPC therefore concluded that a hold stance remains desirable at this time, as this would indicate a conservative but cautious and consistent policy choice given the prevailing economic conditions and outlook, thus strengthening the policy credibility and focus. It also feels that a hold will signal MPC's realization of the fragility of the growth recovery and its sensitivity to emerging global and domestic uncertainties. Hence, the need to sustain policy trajectory. After a careful balancing of the benefits and downside risks of each policy option, MPC decided to hold all policy parameters constant, believing that a hold stance will enable the continued permeation of current policy measures in supporting the recorded growth recovery and further boost production and productivity, which would ultimately rein in inflation in the short to medium term. The committee thus decided by a unanimous vote to retain monetary policy MPR at 11.5%. In summary, MPC voted to retain 1. MPR at 11.5%, 2. Retain the asymmetric corridor at plus 100 and minus 700 basis points around the MPR, 3. Retain the CRR at 27.5%, and 4. Retain liquidity ratio at 30%. I thank you most sincerely for your attention.
Thank you, Governor. And that was the communique number 140 of the MPC meeting held 24th and 25th January 2022. We shall take some questions from the press. And just tell us your name, the media house you represent, and your question.
Official there, you heard it live from the headquarters of the central bank in Abuja. All rates remain unchanged. The MPR remains 11.5% and all parameters around it remains same. I'm not going to be doing this alone. It's time for us to get more analysis to understand what this means, not just the figures. And I'm being joined by the right person. He's a development economist and public affairs analyst, Professor Ken Ife. Prof, finally, we have seen what the central bank governor highlighted and listened, talking about tightening the positives and the negatives, loosening, identifying what that would also mean for us as a country, and finally retention, which they believe that will consolidate on the achievements of what we have had so far. What's your reaction to this?
I think the analysis is quite robust. because the CBN at this moment has so many balls in the air around driving down inflation, and then of course mainly through the money supply issues and tackling the foreign exchange side of it, and then pushing on food production, because the foodstuff basket index is the biggest driver among the structural factors. So it is doing quite a bit, and they felt that the growth and the recovery are both fragile. And if you have so many balls in the air tackling this issue, that it will be like jumping the gun to begin to tighten. So they rather will have things stay as they are for now, to watch how it was a balanced review of what the ramifications of the normalization of monetary policies in the West, the rising inflation in the West, and measures to contain those, and the possible impact that they could have on our foreign portfolio investment inflows, and all of that. But they've just balanced the risk in favor of holding the parameters and having less ball in the air, and seeing how those parameters move going forward, and the impact they will have. I mean, they were aware of the uptick in inflation, and of course that was easy to explain away because of the accelerated demand in the Christmas festivities on food in particular, and of course some other items like alcohol and all of that. So I think on balance, then is a reasonable decision. And I think it would be wrong to halt the economy that is recovering and growing, and there's so much impact of other variables on the economic growth.
Prof, are you also optimistic? The CBN governor is talking about consolidating, yes, which we've highlighted, but looking at food inflation, he says all of the efforts, particularly regards to the interventions, that in the short to long term we'll start to see the positives of this. Do you see all of this impacting generally on the growth? Because the fragility of this growth is what everyone is bothered about. And COVID, one way or the other, is still scary, you know, when we look at the figures coming, especially from the global space.
Well, the COVID is not the least of our problem right now, because as a population, we are learning to live with COVID. And two, we don't envisage a situation where we would have to lock down our economic system. Nobody talks about that. I don't even think it's on the table. So, and even though we are among the poorest in terms of the vaccination rates, but that notwithstanding, many aspects of our economy are adjusting to that reality. And in terms of, look, for example, last week we saw the rice pyramid, and over 1 million metric tons displayed in Abuja. All these are paddies. These paddies are going to be released immediately for them to be milled. And then, of course, that will head into the market. That is not just Abuja. It's going to be launched in virtually many states of the Federation. So you will see in the immediate term, in the near term, a huge releases of maize and rice, and that would obviously impact on food sub-inflation index, which has been the bigger driver of all the five inflation indices.
Moving on, I also remember talking about interventions, staying with interventions, because the impact of these interventions are quite notable, looking at what we've seen in some time now. The 100 for 100 policy also of the central bank, I'm kind of worried, and experts have also talked about this, that what do you think about CBN funding and sustaining all of this? Paying back is also something that is worrisome. We know what happened. We heard some stories even about the Anchor Bora scheme of some farmers not being able to pay back to the central bank.
Now, the 100 for 100 is actually a good news and is a game changer in respect to the fact that here you had a successful Anchor Borrowers program that have revolutionized our agricultural production system, and now put the farmers on the driving seat, with nearly 4 million of them receiving loans without collateral. So that is a fundamental shift, and it is commercial farming, which is being integrated to national and global supply chain. Now, the next phase is to bring in a major thrust on the manufacturing and value addition, which is what 100 for 100 is. So it's coming there to actually push both forward and backward linkages. In other words, take a lot of this growing capacity at the production side, and then transform it and ready for both meeting domestic production and then also meeting export requirements. So that is a necessary bridge that needs to be built so that you can have a sensible balance between the three primary components of our GDP, which is the agriculture, industry, and services. So it is so critical, and that's where you begin to think about how do we increase foreign exchange earning, how do we reduce the importation bill. All of those are going to be answered by this 100 for 100, and I'm glad it is popular. When 224 have applied for it, we are looking for less than 50% of these people for the next 3 months. So it's already posting a success, and they're asking for 234 billion, which is not even as much as what is expected, because we are looking at about $5 billion per project. So as a maximum for that field. But if you do have projects that are much bigger than that, then of course the board of the CBN will have to look at that. So they don't rule anything out. So it's a sign of interest, great interest to manufacturers. Now, coming to the credit side of it, yeah, I know that some of the farmers, the 1 farmer 1 hectare, have been a bit sluggish in the repayment of their loan. But I have to tell you this: anybody who doesn't repay the loan has not actually applied the loan in agricultural production. That I have to tell you. Because when you look at the economics of production of any of the crops, I've seen all of those, and I'm very well, if you look at the economics of production of each of these crops, whether it's rice or maize or cotton, the input cost comes to about 25 to 30%. So there's a huge margin of profit, not less than 50%. So if you see a farmer that actually planted, then one ton of your maize or 1.5 ton will pay for your loan. But some of them are getting 5 tons per hectare. So it's just whoever didn't pay, it's not because they didn't get the money, they just didn't plant anything. So those who planted and harvested cannot give you the excuse of there is a flood and all, because they were all insured. 2% of their loan went to insurance. So there is a cover to pay for any distance. So, and there's a lot of risk mitigation instrument being applied to that lending. So that's why they're not even bringing the collateral in the first place. So we don't buy those stories. So what will happen is this: when they will get into serious enforcement, they already have a global standing instruction. They will start sweeping the account of the farmer in any bank that they have an account, or any guarantor that they use. They will start sweeping. But having said that, though, the repayment of the loan from prime anchors is over 90%. That is the big private sector that are borrowing substantially. Their repayment is over 90%. So this program is successful. And I know that the 100 for 100 would even be more successful, because they are going to be plugging into the production capacity of the likes of the Anchor Borrowers program. So they will have raw materials from Nigeria, and it's designed for them to utilize at least 50% of the raw materials in Nigeria, and to focus on local employment of over 80% of their employment. So that is the last piece of the jigsaw. And I'm very confident that they will all add up.
Prof, I'm very interested in the aspect of subsidy that the governor of Central Bank talked about, because we're expecting that would happen anytime soon, and we're thinking of what the impact will be, definitely on inflation and all of that. But the central bank governor is also saying that this needs to be done strategically, like trying to alleviate the sufferings of Nigerians, because obviously we know transport fare and all of that, price of food stuff and all of that will be on the high side if this happens. What is your reaction to the talks around subsidy around this time as we try to grow our economy?
I, for one, am patently opposed to subsidy, especially at the level of consumption. What you subsidize is production. Especially, I mean, you go to Europe, they continue to subsidize their farmers. That anything you talk about, bringing it into the negotiation, they won't agree. So if you subsidize farmers, fine. That's where you need to put your money. If you subsidize, you don't even need to subsidize modular refineries. All you need is to loan them money. They will pay it back. So there's no subsidy going there. So the law, the new revised PIA has requested that this does take place on a certain timeline. But it is now considered that that timeline is unrealistic. Because even my advice to government at various levels of government, I have said that they need to have wider consultation. A wider consultation among the strategic stakeholders, which are federal, state, and local government, and all this. Then they'll come out again and have a second level consultation with the industry, the labor, the current producers, the oil marketers, the Dangote refinery, and all of that. So that you can see a declaration of capacities and see the build-up of recovery from our government-owned refineries, see the build-up, how they intend to build up capacity from their maintenance, and how Dangote plans to build up capacity. And then you see how you phase the reduction against the increase in capacity so that you don't have any gap. So, but that kind of thing can trigger when you have had exhaustive consultation with all the layers. Otherwise, you're going to have a real fallout that will not be very pleasant in an election year. So I'm glad that they have commenced those consultations with intensity, and that they are allaying the fears of marketers and the public that is going to happen overnight. So the hoarding will stop and panic buying will stop. So that's very important. Why the real discussion takes place, and we know what we are doing. I'm not personally happy about putting one day when you say the price will rise from 160 to 400. I don't want to have that. You need to do this in a very phased and sustainable manner, so that everybody knows what to expect. Everybody agrees on a timeline, and they build up and build down of capacities, and then see how it goes.
And before I talk about the monetary and the fiscal side, of course, fiscal side complementing more of the efforts on the monetary side, I'm also looking at Forex, which is also the big elephant in the cupboard. And we talked about the governor identified diaspora remittances as a little bit of improvement. But what more incentives, what more can be done to improve, to stimulate remittances from abroad?
Well, there are talks now of some remittance trust fund or something. There's some more talk now on that area from investment point of view. So I think that is a big one, because the diaspora will be keen to engage in that process. And the IMTOs, international money transfers, I think I should like government to maybe add 1%. Or demand 0.5 to 1% of their commission to go to that fund, that diaspora investment fund, as well as find other ways and means of building up that fund, because that fund will now come handy to fund infrastructure, to fund education, to fund health, to fund private sector intervention in many of these areas in agriculture, and find those areas where the diaspora will connect. Because so that they are putting their money, they expect that all the industrial area that they will connect to will be there. So that would be very, very handy and very, very helpful. So that's that. But I also think that if you look at the spending plan of government in the borrowing plan, they're looking to borrow 2.57 trillion from domestic sources, 2.57 trillion from external sources, and then 1.16 trillion from bilateral and multilateral loans. I would suggest that government borrows more from the domestic side than from the foreign. But of course, if the NNPC is not sending their money to central bank, because they normally should be sending about $3 billion a month, nothing came in the whole of last year. If something was to be going, then it will reduce the pressure on government borrowing externally as one of the ways of giving dollars to the bank. For the central bank. So that's one of the sources of dollars, because we do have commitments to external servicing of foreign dollar-denominated loans. So we will still have to have channels that send money there. Diaspora is one of them. But otherwise, under normal circumstances, if a lot more borrowing is done internally, what it will be, and you give them a reasonable rate, then what it will mean is that you now use that to begin to mop up excess liquidity in the country and the economy right now, because there is a lot of money in the system fighting COVID, money from fiscal and monetary authorities, a lot of them are in circulation fighting COVID. So we need to begin to take a lot of some of this money out and using the treasury bills, offering a good rate that would interest even the foreign investors. The foreign portfolio investors will come if you are having a reasonable rate of yield on those securities. So you begin to use that to mop up the liquidity, because we're in an election year where even more money will come into circulation from politicians. And some of these politicians, I hope they can bring their money in dollars, because that will help us a lot. If they can bring some of those monies they have in Switzerland and wherever they have them, bring them into the country for elections, then we can have some of those monies accrete to the foreign reserves. But of course, the oil is very promising in terms of higher prices. So on balance, we're going to have a better year this year than last year in terms of growth and recovery.
Well, wrapping this up now, just staying with the fact that it's an election year and everyone is worried, talking about spending, what the effect might be on the economy and all of that. We've seen the central bank again talking about the creative sector, agri sector, pharmaceutical sector and all of that. And with all of this support and intervention, the fiscal side has a role to play. Do you see the fiscal side giving that support that is needed at this time as we move to 2023?
No, the fiscal side is trying, to be honest with you, because what the fiscal side has done has not been done before. Every year they bring in Finance Act to smoothen the edges, to constantly be reviewing and plugging the holes. Every year they start the budget at January to December. And even this year they've allowed another 3 months till March for the expenditure of last year to continue. What is continuing till March is not revenue expenditure, it's not salaries, because they paid all the salaries. These are capital expenditures that are giving us even more opportunity to create more jobs and to add to growth in the economy. So investment is everything. It's an investment that creates the economic activity, which creates the jobs and disposable income. Then people can buy education and health and sustainably reduce poverty. So I can't afford the fiscal side. Fiscal side is working extremely hard and hand in gloves with both the National Assembly and also with the monetary authorities. We've not had this level of coordination between the two authorities, fiscal and monetary, irrespective of what any people say. The critics will always say something, but where's the evidence? The evidence is that they're working well, working together. They both tackled COVID decisively and sent it away within 1 quarter. Unlike in 2017, everybody was everywhere. And they took how many quarters? It took about 5 quarters before we could come out of it. But this is not the same. There is a different regime.
Well, it's a good way to leave it. Discussions definitely will continue around this decision. That's much time can take. I've been speaking to development economist and public affairs analyst, our own Professor Ken Ife. Prof, thank you so much for joining us to analyze the resolutions immediately as we got it live from Abuja, the CBN headquarters. We appreciate this.
Thank you very much.
All right there. Well, before we go, let's just tell you that the market is closing positive today with the index up 0.02%. Top gainers, we have Kodva, we have ETI, Academy Press, and we have Champion, Regalinks. Top losers, CNR, Lizin, Prestige Insurance. We have Cheap PLC, Conest, M Benefit. Indeed, that's our show today. Thank you very much for watching. It's a different one because it's the first MPC meeting for the year. We needed to follow proceedings and bring you up to speed to make sense of the figures that were reeled out about the Central Bank Governor. Thank you so much. I'll see you tomorrow. And of course, the discussion around the world of business continues. Stay safe.